we touched on this a lot. This is one of my favorite things to run through, and one of our main strategies we personally use is cost segregation studies. Using that through real estate professional status, I think this is something a lot of people have interest in because we've talked about it a lot or they've researched it. But let's talk a little bit about first, what is real estate professional status? What are kind of the bullet points to qualify for that? And how can you take real estate and other things to go through and write off additional streams of income, particularly with the cost segregation study?
Let's use Lorraine and I for just a moment. Let's assume that Lorraine is making $500,000 running our tax firm. That's not real estate. Okay. If I'm a real estate investor and I'm a full-time real estate investor, I have to spend 51% of my time investing, managing, and I'll get to this in a minute, and or working real estate. I have to have material participation. I also have to prove 750 hours for the year. One works out to about 15 hours a week of doing development or redevelopment, construct or reconstruct, acquire, convert, rent or lease, operate or manage, or brokering real estate. Now, what I did was I just read exactly what the code says. And if you want a little more definition, we are offering a resource that gives you a little bit more definition of what the code says. So just know that when you come in for evaluation, you can get a resource that talks about real estate professional status.
And Jim, just real quick to stop you, I think Adam had another point to ask about as well, but this is not something you're actually applying for, right? This is not an application. I mean, if you go into your CPA and say, do I qualify for real estate professional status? I mean, they may not be able to guide you, right? It's more or less, here's the criteria, and you tell me, do you meet this criteria? So it's important to know, am I able to justify this? So when we're saying qualify for real estate professional status, really what it boils down to is, would you meet all these criteria in the sense that in the event that the IRS were to ask you to justify this in an audit or something like this, really, right?
And the IRS does require you to keep a log of your time to be able to prove your time.
Yeah, and what I was going to add, Zach, is that it is not an application. It is not licensing.
Yeah.
So it is activity. Remember, we talked about real estate being passive for those W-2 people who are full-time. And now we're changing to real estate being active. An active business is like, okay, you're opening up, and you're selling a product or service. That's an active business. So now we're making real estate active. So the IRS says a minimum of 750 hours plus. But what we have found is the IRS will go through the log and they will say, no, we're going to disqualify these hours and these hours and these hours. So you really, in real life, you really want to have more like 1,300, 1,400 hours in real estate and log it.
Yeah.
Anytime
you touch real estate should pretty much qualify as material participation, physically contacting the real estate, physically seeing the real estate,
going to trips, looking at the real estate, visiting their properties.
What about research online, though? What about running numbers?
Oh, yeah, absolutely. Yeah. It all depends on which one of these categories you're having. And what we're suggesting is a couple of things. First, I love things that are easy. At the end of each year, you contact your cell phone company and you get a bill, and they'll literally give you time-stamped how much time you spent on different phone calls. And for instance, if you're dealing with Adam or Zach on a regular basis, you find their phone number and you highlight it, and there you go. If you're contacting us, there's no way you're having a conversation with us and not talking about real estate. Yeah, highlight that phone number. So that's one resource to help you prove your 750 hours. The second part is any kind of an Excel spreadsheet or even a grocery bag with times listed on the back of it. I literally saw a client who did that. Okay. So the IRS does not require how the report works or looks. They just require a certain amount of information, and that is time, activity, address associated. Those are the three basic components.
And do you want to talk about real estate agent, real estate broker?
Oh, I love this one. Zach, funny thing. The IRS does not consider real estate agents, real estate professionals. Now, for me, I've always thought that was hysterics. Being a real estate investor, you know that sometimes it's difficult to find a real estate agent who actually knows, right? Real estate broker, if you are a real estate broker, any of your brokerage activities can be added for real estate professional status. Okay. That's the only licensure commentary that they have in the tax code. Beyond that, it's all about the activities.
But you don't need any sort of licensure in reality.
That is
you can
correct.
Be inactive.
No license required at all.
Yep.
In fact, that was one of the conversations we had early on. If you're licensed, you got to tell the people you're doing business with, oh, I have a real estate license. Okay. If you're not licensed, you don't have to tell them that you have 300 hours of expertise this year alone, much less the thousands and thousands of hours of experience in the past.
Of course.
So we kind of like the idea of just like taking RE Pro status.
And it's so simple on the tax return. You know where it says on the first page, your occupation, where it says your occupation, it's RE Pro. It's just occupation RE Pro.
I love it.
Yeah.
And that's what we've titled the resource, RE Pro. Now, quick comment. Let's sew some of the buttons together that we've talked about. Okay. First, buying real estate is very tax efficient. I think we all understand that. Second, you can put your kids on payroll. We talked about that. Third, we talked about you can borrow money tax-free to buy real estate. Here's the fun part. Let's assume for a second, Adam, I'm going to pick on you and your 11 children. Okay. Imagine for a minute, Adam, that you borrow money to go buy real estate. You get the money tax-free that you put into the real estate. You buy enough real estate that you can get accelerated depreciation, cost segregation, real estate professional status, the whole 9 yards. So now you're getting tax deductions against any and all forms of income, interest income, rental income, earned income like W-2 jobs. Maybe your wife is a nurse or something of that nature. She better have some experience with 11 kids. Okay. The point is, you're now getting tax-free money to put into a tax-deductible asset that's growing tax-deferred and is producing cash flow tax-free.
It's a lot of tax.
Yeah, it's mind-blowing. And if you here's the fun part. I'm a nerd. I'm sorry. I have to admit this. I actually have a collection of calculators. Okay. When you actually calculate out the ROI and include the tax savings, it's significant, truly significant return on investment versus anything else I know of that you can invest in.
The hard thing is just calculating it, right? Is first of all, you got to understand this stuff and you got to run through, and then you have to apply it. And then you have to track it and actually run those numbers. So when you look at this side of the house, and Adam knows, when you really do a deep dive, and I only am touching the surface with some of these things, but already that tax benefit has been significant for us in our business. I mean, yes, ROI skyrockets, and then you can couple that with, okay, this is money that you would have otherwise given to Uncle Sam, but then you can go out and reinvest that and then yield a return on that. I mean, it's just endless. It's endless and endless. And that's how, that is truly how the wealthy build generational wealth and compound and preserve and protect their wealth over time, is you have to be actively engaged and be doing this type of stuff. And people give me a hard time because we run depreciation, just normal depreciation in our ROI or debt reduction, right? And it's like, man, if you really knew the intricate details of how significant this is the stuff where you really, cash flow is important. Cash flow is not the most important thing investing in real estate. It's really applying these type of concepts long term.
And stacking them and layering them. And one of the things Jim and I are passionate about is educating people and letting them know that these strategies are out there, because it is a myth that you have to be wealthy in order to use these strategies. Anybody can use these strategies and supercharge their wealth.
Yeah. There are 3 tax benefits for just owning real estate without real estate professional, any of this other stuff. And that is tax deferred growth, tax-free income, and the tax-free pay down of your mortgage. That happens tax-free.
So we talked a little bit about, and Adam, cut me off here if you you have some things you want to jump into. I just want to kind of make the transition to, okay, we talked about real estate professional status, but really the big benefit with that is taking passive losses and applying it to active income. This could mean someone that's an attorney, doctor, lawyer, engineer, if they have a wife that, or a spouse or husband that's doing real estate related activities, and applying that. I mean, and they're an active investor, that can be applied to take those passive losses against the active income, and specifically cost segregation study. I think we've touched on this enough in our previous episodes, but let's just talk about really what that is and how we define that real quick, if you don't mind, Lorraine and Jim.
I'm dealing with a very successful young man. He lives in the Kansas City area, and he has friends who are investing successfully in real estate. And he said he wanted to go invest in real estate. So our team put him in touch with me. And he said, well, why do I need tax strategy? All I want to do is spend money on real estate and go buy real estate because it's a really cool investment. And I said, well, let's go through the strategies and let's see what happens. I found out his wife works for his company, meaning she could decide to not work for his company and it wouldn't affect their income. Okay. And it's a very rare opportunity for a husband to be able to say to his wife, you're fired. Okay.
You're fired and you're welcome.
Yeah.
Exactly. Once we were done with that, we were able to establish that she could take real estate professional status. Lo and behold, we saved them, I'm not kidding you, $175,000 in tax. $175,000. It does not take a rocket scientist to figure out that that's a chunk of money for a down payment, courtesy of the IRS.
I think whenever, talking to people daily about this, as they want to kind of achieve their financial freedom, it's something that you should always be looking at is, let's just talk about maybe replacing one income and getting you out of your job so that we can, work on getting you the status so that now we're offsetting my active income. And it's just a strategy that everybody can employ, like you were talking about.
Yes.
And it should definitely be something you're thinking about. Like, there's no need to maybe think about replacing a little bit of mine and a little bit of my wife's. Why not just focus on one, get them off? Because, you can't really be, I don't think, based on what I've read, you can't be a real estate professional if you still have a full-time job. It's impossible, according to the IRS.
Right.
Yeah.
So
there are many cases where people have lost that argument with the IRS. Here's an interesting comment. We have gone through this process with many people. And I have a intelligence officer and a nuclear engineer as a married couple. And the goal was to get the nuclear engineer wife free from her W-2 job. We got close to it. We showed them how the math worked. We realized that she did not have to work. And I asked her, do you want to still work? And she said, actually, I do. So here's the theory. The theory is not freedom from work, but freedom of work. She now gets to go to work every day, and she knows the minute it's not a place she wants to be, she can say bye. Changes the work environment, doesn't it?
I mean, that's really what it boils down to. That's big picture here, of course. Absolutely. Real estate itself can become a full-time job that you don't always enjoy. You know what I mean? But if you're setting it up appropriately, it's about having that flexibility and that income that's still being produced, whether you're actively working or not. Just a real quick touch on the cost segregation so we can move along to our other bullet points. Basically, what a cost segregation is accelerated depreciation, where you are taking that a portion of that property, the value of it, loss against the first year, that year. And this could vary. I mean, I've seen people in mobile home parks take upwards of 80%. That's just crazy of the value. And you can take cost segregation studies on single family. Some people assume that you cannot, but you absolutely can. If you have a $100,000 property and you get a 30% deduction in year one, that would be equivalent to a $30,000 deduction. Now, real estate professional status is allowing you to take that against your active income. You don't actually need to be a real estate professional to do a cost segregation study, but that is where you're actually taking that against active income. Did I state that appropriately? Anything to correct, Jim and Lorraine?
Yeah. So what happens is there is some details and some rules. So it's based on adjusted gross income. So if a couple or a single person, doesn't matter if it's joint filing or single, it's $100,000 of adjusted gross income. Somebody can take a cost segregation and go negative up to $25,000. So that would bring their income from 100 down to 75.
That's without real estate professional status.
Without
anybody.
real estate professional status.
Yeah.
And then if their income's 125,000, it's about 12,000 negative. 150,000 AGI and up, then the deduction on whether it's cost segregation or expenses or whatever is limited to the amount of positive cash flow.
Right.
So then at that point, it's like, okay, how can we get one spouse to qualify for RE Pro? Does that make sense? Or what are the strategies that we can utilize?
Well, this is paramount. Let me just restate what you're saying real quick for everyone and make sure we captured that. If your adjusted gross income combined is below $150,000 without real estate professional status, you can be taking your passive losses against your active income to go negative. And it's limit, it's depending at where your adjusted gross income is at $100,000 and less. It's a $25,000 deficit phased out at $150,000. Once real estate professional is talking about those individuals above that $150,000 taking those active. So most people should be considering taking those additional losses on their real estate. So I love that.
Yes.
really
yes.
wanna hear
So many people miss that. And I'm like, oh my gosh, it's like they missed it. However, Adam, you asked a great question. What about last year? So even though last year is over, you can still get a cost segregation up to your filing. So extensions are October 15th. So you can still get that done.
It just needs to be a property that was in service before you owned it before the end of last year. And you can also do cost segregation on properties you bought a while ago, right? It doesn't have to be bought in the year preceding necessarily.
Correct.
Okay.
Generally speaking, as a rule of thumb, if the property was within 3 years of its purchase date, cost seg works really well. Certain circumstances, you can expand that considerably depending on the property and the circumstances. But yes.
Or capital improvements.
And capital improvement, that's another good one. Okay.
Yeah. So if our listeners want to go back and see and hear Zach completely nerd out about cost segs, just go back into our archives and search cost segregation. We did a whole episode with the cost seg specialist, and I think it was about 45 minutes long, where they went down a rabbit hole, because when you get Zach talking about taxes and cost segregations, you've got a good conversation going. So
I love that stuff. And that's Steve Tressel, because he's a guy that I personally use to do ours. It's cost segregation is having an engineer go through and actually give a detailed report of what things you can take accelerated depreciation on, because obviously not everything in the building is going to last for the full depreciation. We buy a lot of commercial assets, which we typically see in, we reduce the land out of it, but typically we're seeing between a 30 to 40% depreciation in year one, meaning you buy $1 million building, that could be a $300,000 to $400,000 if that's all improvements, not including land. That could be a $300,000 to $400,000 deduction in that first year. You still get normal depreciation year after year following that, but that's just allowing you to be more creative, to not have to pay that money to Uncle Sam in year one and then go out and reinvest it in other stuff. Okay, let's talk about capital gains. We hang on here, people, because we still got some very essential stuff that is going to save you a ton of money in taxes. If you have to go back and listen to this and take notes, please do. Again, rentretirement.com/tax is where you can reach out to Lorraine and Jim to actually set up a consultation with them. They're doing an analysis. They typically charge $500 for the average individual. They're doing it for any rent retirement clients for $97. That's just an initial analysis to kind of give you a big picture, and then decide if you want to proceed with them to go further into your tax strategies.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.